messes it up royally. So people are kind of like, look, it's much easier to capture one regulator than multiple regulators, right? So it got split up. And it got split up into a part that regulates basically securities and derivatives, payments, separate regulator, prudential, and they created an interesting new regulator after the global financial crisis. I'm not aware of any other regulators. You know, the crisis brought about this financial stability mandate, because prior to that, regulators didn't have a financial stability mandate. If you're a central bank, you're in charge of monetary policy, you have a monetary policy mandate, but you're not really in charge of anything being stable, right? So financial stability, new mandate, but then if you really want financial stability, you want to have one regulated entity and one regulator. That's very stable, because you know exactly everything about it. It will lead to monopoly. It will, you know, completely kill competition, because regulators have an incentive now to regulate one entity. It's very stable. It's as stable as it gets, right? So UK has created another regulator called Competition Markets Authority. And that's a regulator that says you need to introduce more competition. That's how mobile-only banks came about in the UK, because the Bank of England would not give out banking licenses. And they said, we just had a crisis, we need to bail out banks. How is it that we are okay? So it got split up into a bunch of things, and the new regulator was created. So these co-authors are where are we? Yeah. So we have co-authors here. Shall I start?
Yeah.
We warmed up? Mm-hmm. Go? Okay. Joint work with Vladimir Kraus, Oliver Linton, and Ming-Mei Shao. Ming-Mei is a PhD student who is worked with Oliver. So Oliver and Ming-Mei, about almost 4 years ago, got to talking to the FCA about getting access to highly proprietary regulatory data, because some of the questions that we're going to be asking here require you to have access to this data. I worked, as you know, in my work on high-frequency trading and other things with highly proprietary regulatory data. So there are some questions that you can only answer by having trader IDs. Because unless you know trader IDs, just looking at prices and quantities, and things could come out in a variety of ways. So they started working on this. And Oliver is a financial econometrician. Ming-Mei is the, well, more of an econometrician. She's an econometrician. I model a bit and sort of try to understand the data generating process. Vladimir is the person who is our interface to the data, because you can't really get into this data without actually someone on the inside in this entity. And so he knows everything, as much as you can know about the data generating process, but he doesn't model, and he doesn't really do complicated econometrics. So we have a team of people doing different things. Yeah. ETF mispricing. Let me start out with a sort of a general sort of slide. You all know about exchange-traded funds. In my opinion, in securities markets, this is the most important innovation in securities that happened over the last 20 years. And as you can see, they're huge. You know, there are a lot of these ETFs, and there's a lot of asset management flowing into them. And what an exchange-traded fund is, as you can see the definition of the bottom, is a fund, meaning that it's a wrapper around existing assets. So they're assets that already exist. They could be stocks, they could be bonds, they could be crypto. And you take these assets, you put them together into a fund, which is a regulatory definition. You put a wrapper around it, and you say, and you issue a separate exchange-traded security that represents cash flow from these assets in this basket. Yeah. So for a long time, the question to me was like, why are there so many of these? Like, why do you need thousands of them? Like, I can understand S&P 500, gold, commodities, treasuries, maybe high yield bonds, but like thousands, what's the secret sauce? Why are they there? What do they actually do? They are, from the point of view of like standard economics, this is a redundant asset. It does nothing that a collection of these assets in the basket cannot do themselves. And for a long time, the narrative was like, look, there is, once you package them together, the frictions, the costs associated with managing these baskets go lower, whatever. I was never quite believing in that. No, never quite knew just sort of what that is. I talked to people at BlackRock who actually package this, and I'm like, what's the secret sauce? And they would just mumble something. I'm like, I'm not believing these answers. I know, it's just like, sounds kind of funky. So I wanted to work on it for a long time. And finally, there was access to data that enabled us to ask some of the questions that I hope are of interest to you as well. And the questions that we want to ask here in particular, after I give you some definition, would be, how do you price these things? How do you actually price them? We don't have an ETF asset pricing model. So this will be our attempt to actually price ETFs. The way to price these things, since they're represented, would be there's a price of an ETF, the actual security that's traded on the exchange. And there's something called net asset value, which is the value prices of the underlying securities. Yeah? So there is an NAV and there is an ETF price. And ETF mispricing, it's not our term, would be the difference between the ETF price and net asset value. At the point in time, net asset value is typically calculated at the end of the day. You can calculate it throughout the day as well. Are they the same? They're not the same. They're not the same. So what you see here is for a very particular ETF. This is a highly, highly liquid exchange-traded fund, broad exposure to global companies in 23 developed countries. This is for pedagogical purposes, for illustrative purposes. Issued in 2009, so not new. Yeah. So market cap is 50 billion pounds. And what you see in here is, in percentage term, ETF price divided by net asset value scaled by the price itself. Yeah? And as you can see, it's not zero. So it could be higher, it could be lower. It sort of fluctuates in price. And if you're just now look at it at the statistical process, you're just looking at it at the statistical process, what you may see, and this is how I would see it, it has mean zero. Yeah, it sort of fluctuates around mean. It's around mean zero. Could be higher, could be lower. It has memory. You can see if it's higher, it stays higher, and then it kind of reverts. If it's low, it stays low. Yeah, it has memory in it. So there's some sort of an autoregressive component around mean zero, and it has jumps. Yeah, so it is a process that has these three properties: mean zero, memory, and jumps. What gives rise to these statistical properties? Where do they come from? What gives rise to memory? What gives rise to mean zero? And what gives rise to jumps? So to zero, typical thinking that we have is there's some sort of arbitrage. When this ETF price minus net asset value just too far sort of away from each other, there's a way to make money. Buy one, sell the other. Sell one, buy the other, right? So mean zero is probably related to some arbitrage. But why doesn't it like just go to zero and stay at zero? Yes?
Can it be converted? Can I buy shares of this fund and someday come to the fund and tell them, give me the other one?
100%. Yeah. Yeah. You can do that. Yeah. So, yeah.
I thought you had to be an authorized participant.
As an authorized participant, you can do that. Yeah. So not everyone can do it, but some can do it. Memory, maybe there's something that should be responsible for the memory along the lines that you said. Can you do it, but how much of it are you willing to do it? Yeah, so if it's out of bounds, but you have to carry costly inventory doing that, you're an intermediate, right? So you're not necessarily going to do all of it, okay? And jumps are perhaps, could be related to, there are some periods where you're like, look, there's something going on. Maybe I'll just sit it out. See if it reverts, and then I'll get in. Yeah, so you can see how within this data generating process, you can need to start to look at the role of those who are in the middle of these markets. Who are they? So the way that these exchange-traded funds are designed, they're designed around very, very particular type of intermediary from the very start. And that intermediary is absolutely crucial to the design of this asset. For some assets, they're designed as, capital raising exercise, a stock. And then there could be market makers who could be designated, increasingly not designated, who choose to make markets on this asset. In here, it is designed around authorized participants. So what are these authorized participants? Authorized participants are financial intermediaries. They're regulated entities in some way, in one way or another. They will be present on these exchanges. And they're authorized. What are they specifically authorized to do? They're specifically authorized through a contractual agreement with the sponsor of the ETF. So the ETF is sponsored by an entity. It's a primary issuer of the ETF. So think of BlackRock. BlackRock creates the ETF. BlackRock is not responsible for managing the ETF price or mispricing or whatever. That is not what it does. It applies to a regulator for prior to a recent act. It had to comply with the 1932-1933 Act. So it is given a license to issue this security in the primary market and an additional license to list it on an exchange. That's the role of the sponsor. The sponsor issues it. But the sponsor also enters into contractual agreements with a number of, it's not an unlimited number, of financial intermediaries who are authorized to create and redeem shares of the ETF relative to the underlying. It's a very interesting asset. So when you think of a stock or a bond, we typically think of an asset in positive net supply. It's a positive supply of it, and it's relatively fixed over periods of time. You can buy back, you can reduce the supply, relatively sort of infrequent. You can think of futures. These are assets in zero net supply, meaning for every buyer there's a seller, and if it's listed on the CME, the open interest could be larger or smaller depending on whether buyers can find sellers. But it isn't zero net supply. This is an asset that is in variable net supply. The supply of this asset, the actual quantity in the market of how much of this stuff is out there, varies daily. You can create and redeem daily. Yeah? So if there is a lot of this asset out there and authorized participants are not finding ways to place it and trade it in the secondary market, they'll grab a basket of assets from the secondary market, redeem it, and they're done with it. Yeah? They will be doing it to make money. They're not going to be doing it. They don't work for the government. They're not on sort of public payroll. Yeah? With me? This is how it does. So authorized participants are absolutely critical to the design of this instrument. So market makers are sort of critical to the secondary market operation of an asset. The authorized participants are critical to the actual supply of it. Yeah.
Perhaps this is a bit jumping the gun, but
Go for it.
I was wondering, is there any real-world evidence that, let's say, if there is an ETF issued by JP Morgan, another subsidiary of JP Morgan, a fund associated with JP Morgan is trading against that and doing this arbitrage? So we did have, I mean, normally there are these Chinese, this is exclusively Chinese walls, but do we know that this could happen?
So ETF sponsors are typically asset managers. They're typically buy-side institutions.
But some of them also have sell-side.
So they're typically not sell-side operations to begin with, right? So this would be State Street, it would be BlackRock, it would be Invesco. So they're asset managers. They have certain assets, they package them, and they ask for regulatory approval to trade a claim on this. They themselves, do they themselves trade in this? Certainly JP Morgan trades on this. I think the question is, do we see BlackRock or BlackRock entities trading in this are actually authorized participants in this? The answer is no, we don't. Whether or not as part of the regulatory approval, most likely, because that would be just like really unfair, because they know what it is and they're going to favor their entity. And if, you know, BlackRock has a BlackRock affiliated authorized participant, would you also want to be in it? Probably not. So someone probably have thought about this and went through this process before. You certainly want competition in this space, and so some competition is going to be present. And it would also surprise you. I will preclude some of the things that you're going to see. The largest authorized participants are not who they think you are. They are. They're high-frequency traders. So largest authorized participants by now are machines. They're there just to make money. They're not sell-side, they're not buy-side, they're just shred. Okay, so you can say that the largest authorized participants are, in terms of trading volume, are actually proprietary traders. Fair?
For stock ETFs? For equity ETFs?
All around, all of them.
Andrei, can
Yep.
you please clarify, from the example you've given there, it sounds like mispricing is a misnomer. It sounds like that's compensation for risk. So why, can you clarify why you call it mispricing?
It's not my definition. I don't like the term mispricing.
Okay, can you clarify that? Why is this not considered compensation for risk? Because your example there is the AP could hold this, something happens like COVID and is stuck with this inventory. That's compensation for risk, it sounds.
It's a compensation for someone. Let's find out what that is.
Okay.
I just showed you in this chart that it's there. This is an empirical fact. Even though this is for pedagogical purposes, I can show you in a whole bunch of other ETFs, it's going to be there. It's going to have very similar properties. Let's find out what that is. And sometimes it's not small. This is like a lot. Like this is, and as you can see, if it gets elevated, it stays elevated. So you can call it discount, you can call it compensation, you can call it something, but it's a deviation from net asset value of the actual security that's traded as an ETF. Mispricing, that's why it's in, remember in my, I don't know if you saw the beginning of the slide, it's ETF mispricing. Yeah, in things like, this is kind of the best I can do given like what people have already put a label on it. Yeah.
Do they call it, don't they call it creation redemption arbitrage?
Creation redemption arbitrage is going to be an activity. This is what we see the differences in prices. This is kind of the empirical regularity that we want to look at. Where it comes from is very likely from the activity that you're describing. So let's get into this. Are you warmed up? Should we go? Should we try to understand Albert, mispricing is going to be defined as the difference between ETF price and net asset value. Yeah, and this is an empirical fact that we see that mispricing fluctuates around zero, as defined. It has memory that stays elevated for a period of time, and it has jumps. From time to time, it jumps. So we want to understand what could be the source of it. What gives rise to this empirical regularity? And we kind of want to look at authorized participants because they're critical to the design of this security, because they're the ones who are in charge of the supply of the asset. Because they could, through the creation redemption process. This is what we want to do. We want to look at just sort of, is it in some way related? Is mispricing, if you will, a feature, not a bug? Yeah? So it's just perhaps a feature of how this instrument is designed. It's a great instrument. People love it. But there's a particular feature of it that you just have to work with, and this is the feature. Yeah? So, what we're going to do is that we're going to build a model. We're going to build a model around this. I'm going to go over the short version of the model, to show to you a static model, and then tell you what the moving parts are, because there is a bunch of moving parts. Net asset value is moving, ETF price is moving, and authorized participants are conducting operations in both the primary market and the secondary market. There will be moving parts, right? That we need to keep track of. And then we're going to go into the data. We have data on both the primary issuance and secondary market trading with trader IDs for every transactions, every instance of it coming from the regulator. So we can actually ask the questions, what do authorized participants actually do in terms of managing their exposure, both in the primary market and in the secondary market? So two parts to it. Yeah? So in order for us to get into the data and understand how we want to approach this data generating process, we need to organize our thinking through a model. So and the way that we're going to organize our thinking is going to be relative to the literature. And the literature is going to be something about authorized participants has been done relative to their impact on the underlying asset. We're not going to look at the underlying asset. We're going to stay in the ETF. Our ETF is our focus. What authorized participants do in the ETF. Underlying asset, we're not going to say anything really about it. Some people have said it, that if you have underlying securities in the baskets that are illiquid, and the ETF is a price discovery vehicle, which is much more liquid, you're going to have information flowing and the price impact hitting this underlying, and because they're illiquid, they will be overreacting. Fine, people have done this work. We'll let them do what they do. There's work on price discovery and state space models, which we're going to employ in some way. So the state space models will help us create a system of coordinates around which we should think, we need to think about it, because there are a lot of moving parts. Yeah? And liquidity, moving beyond descriptive results, limits to arbitrage, because in some way it's going to be related to, if there is an arbitrage opportunity, why doesn't it just go to zero and stay at zero at all times if you can just keep making this money? Yeah? So I described to you, this is just I'm a visual learner. I don't know, maybe some of you are. Sometimes it's easier for me to think visually about what things are. So there's an authorized participant in between an ETF investor and the ETF sponsor. ETF sponsor, think of BlackRock. ETF investor, think of someone, a retail or institutional investor who wants to buy an ETF. So the ETF sponsor goes through the regulatory approval and enables the ETF to be traded in the secondary market on exchanges. So there's a market for the ETF itself. It is listed, let's say on NYSE Arca, and ETF investor comes and trades this ETF, and typically this investor is going to, at least some portions of this trade will go through a market maker. Market maker is going to be there, And oftentimes, authorized participants and market makers are the same entity. They make markets, and they also, in the secondary market, and they also can create and redeem relative to the ETF sponsor. They need to manage their inventory. They can manage their inventory in two ways. A traditional market maker can only manage their inventory in the secondary market. If they hit with demand, there is only one way for them to manage inventories, to go back to the market and undo it. Authorized participants can manage inventories both in the secondary market and also in the primary market. A primary market is in-kind redemption, meaning it is not price related. If I'm authorized participant and I come to BlackRock and I say, here is the basket, give me ETF shares. By contractual agreement, BlackRock will have to give me ETF shares irrespective of what the prices are. Yeah, if I say I brought you this, you give me the shares. Yeah, so I could then manage my inventory. If I accumulated a lot of these things, I'll just say, look, you take them. I don't want them. So two ways to conduct this. They work for themselves. They make money. So what does this inventory look like? The same ETF for pedagogical purposes. This is the figure that no one was able to see before. We're able to see it now because we got access to this data. In particular, access to primary creation redemption data from the ETF sponsor. So what does it look like? So this is for a particular authorized participant in the ETF that I showed you before, highly liquid ETF. This is their net position, end of day, quantities of ETF shares that they have in the secondary market and in the primary market, and net red. How do we calculate these quantities? During the day, and authorized participants buy and sells, buys and sells, buys and sells. We count all the buys, we subtract from them all the sells, and if at the end of the day we see that that number is whatever it is, that's a number. That's counting beans. There's no econometrics, there's no regressions, there's no nothing. We're just saying, you bought 50, you sold 48 throughout the day, your net inventory, 2. Primary market, same thing. You've created and redeemed, and at the end of the day, vis-a-vis the sponsor, and at the end of the day, your inventory is another number. So this is a sort of a fan chart pattern. So what do you see this authorized participant do? This authorized participant is buying from the sponsor and selling in the secondary market cumulative. Goes to the sponsor and says, here's a basket, you give me ETFs, turns around, goes in the secondary market, sells ETFs to participants. Very classical looking sort of authorized participants. They don't all look the same way. You can see them accumulating negative inventory, meaning that they're selling more in the secondary market than they're actually taken from the sponsor. Then something happens in 2020, and they're going in the opposite direction. Yeah.
So where does it come from? Are you shorting it? How can your inventory be negative?
How can your inventory be negative? So your inventory could be negative in that you could be managing your inventory in the secondary market itself. So you're a market maker in the secondary market. You don't necessarily need to be flat. So yeah, so you can go into this market and you could be, there is demand for this ETF. You're selling this ETF to someone else. You have another asset in which you are going in the opposite direction.
So that's naked short selling.
It could be anything else that you do in your portfolio.
But regarding the ETF, so you're saying that they are selling an ETF that they don't have.
They're selling the ETF that they don't have.
So that's naked short selling. That's illegal, isn't it?
They're market makers.
They're making markets. You know, they could have.
Market makers can do naked short selling.
These are empirical facts. If you're questioning me whether or not that they can do it, the answer is
The legality of what they are doing.
That's what they're doing. Questioning the legality of it, let's just say my FCA colleagues did not ask me any questions about the legality of it. So presumably this is fine. This is what they do. Yeah? Your question is whether or not this is something that, what's my explanation for this particular pattern I would just say that at this point, let's just look at this pattern, because this is the first time perhaps you are seeing it to begin with. Because in the past, all that you could see is this line. This is what they're doing. You knew nothing about that. Yeah, nothing. You didn't know what they're doing against the primary market participant. Yeah, you didn't know what they're doing against the sponsor.
Maybe what he's trying to get at is some sort of an accounting validation. So in your data, the sum of the net inventories of all authorized participants should be zero at all times.
Yeah.
Right? So
well, they should be, the sum of all inventories in the primary market should be what that is in the primary market. What is the actual...
So the green and the blue got to sum up for everybody to zero.
They will sum up for everybody, yeah.
So that's maybe just asking...
Not for one participant.
Validation of that accounting.
Similarly, as you say, you go into an asset and zero net supply, you go in to see someone having a sort of negative open interest, but that doesn't necessarily mean it's just for their category.
That's kind of a validation of the data. Is it 100% comprehensive or it's missing? Somebody did not report to 100%.
Okay. Yeah.
Sorry, can you just tell us what the lines are? Because I can't read the lines.
So the lines are one authorized participant in one ETF. This is for illustrative purposes. They participate in the primary market and the credential redemption market with the ETF sponsor, and they also trade in the secondary market. Blue line represents their inventory, how many ETF shares of this ETF they hold cumulative day after day. Green line represents the same in the primary market vis-a-vis the ETF sponsor. Red line is the difference between the two. So this is their total picture of their inventory management. So if they were exactly zero, that means that they would go to an authorized, to the sponsor, they would get one ETF share, they would go into the secondary market and sell one ETF share, zero. Next day, they go to the sponsor, get another ETF share, and sell it in the secondary market. They stay at zero. Their buy-in from the sponsor, that means the positive number, they're selling in the secondary market. They're acting as an intermediary between the sponsor and the secondary market. Okay? Yeah.
So I guess the chart is cumulative sales.
It's cumulative, so
that's why it's the initial position is normalized to zero.
Yep.
Even if it's in negative, does not necessarily mean they're in absolute terms they're showing, right?
so they are,
Their initial
in
position is
the
positive.
cumulative terms, what that means is that the example they just gave you. So you're doing one ETF per day. In cumulative terms, you're going to be at 355 ETFs at the end of the year. Yeah, so it's just going to look like a fan chart. Yeah.
There is opinion that ETF is a bad thing because when the mediocre company becomes a member of ETF, the price discovery of this company is kind of corrupted because its price is affected by the price of entire ETF that may be determined by the good companies, and the mediocre company returns improve just because it's a member of ETF. Do you have opinion on this?
They're hugely popular, like hugely popular in the market. They keep growing, assets under management grow. So I am suspicious about these things because to me they're kind of funky. There's not much I can say relative to a question. I can just stick to kind of what I could say. Let me get to the model of pricing. So we're going to have one ETF. Each ETF share is going to be issued one-to-one for the underlying. So very simple. There'll be one competitive authorized participant who is going to be a market maker and work with a sponsor in the creation and redemption market. There'll be one uninformed ETF investor, think of it as a liquidity trader, who will come into the market for ETF shares with some demand X. Yeah? So what would happen is that this uninformed ETF investor comes and says, I want X shares of the ETF. The authorized participant is going to provide these X shares, and now have to figure out, solve a problem, what do I do with this inventory? You can keep some of this inventory because it's costly for you to manage it, go back and forth. You can go sell some of it in the secondary market. You can create or redeem. Yeah, so there will be no information. There will be one thing. Everything is going to start with ETF price and NAV, and the fundamental price is going to be set, normalized to be the same thing. And what we're going to be looking at is what is the proportion of inventory that an authorized participant is going to keep. Because that's a variable that they're going to be solving for. Yeah?
You said you were not going to look at the underlying, but I find it difficult to imagine these accumulated inventories of the ETF.
I'm not going to look into the underlying in the data. Okay. I'm going to look at the underlying in the model, in the very particular, highly stylized way. And the way I'm going to look into the underlying in the model is that whenever the authorized participant is going into the underlying and doing anything in there, it's going to make a linear price impact. If it wants to manage its inventory by going into the underlying, it's just going to make a linear price impact there. So this is going to be specific to this underlying. If this M is going to be specific to how illiquid the underlying is. So M for high yield bonds is going to be higher than M for S&P 500 equity. Yeah? So this is going to be specific to that. Price impact cost is going to be specific to that. They will also going to have inventory holding cost, which is going to be specific to each authorized participant. Just how good are they at managing inventory? So that's going to be specific to them. It's going to be quadratic in how much they got hit with, and it's going to be multiplicative by how volatile the asset is. We know that holding inventory is costly. We know that price impact is there if you go into the market. Price impact is not linear, we know that. It's typically a square root, linear for now. This is probably not exactly quadratic, but the idea is that it should be in some way more and more costly the more and more inventory that you hold. It's just going to be biting you because you're sitting on something. It should be related to volatility, because if that inventory position for you as a market maker starts moving around by a lot, you probably don't like it as much. So stylized representation. So AP's total payoff is going to be what they do in both markets minus the cost that they have to bear. And we're going to say that our authorized participant is competitive, which is going to mean that they're going to just look for the ways not to lose money. So set it to 0. And then that will enable us to solve for gamma. Gamma star is going to be how much inventory do they hold? And what you will see is that gamma star is going to be a function of parameters. And from gamma star, we're going to solve for what the NAV is going to be as a function of ACE. Price of they set this price depending on what the inventory is. Remember, they are a market maker in the ETF. Here's a chart. Very much easier to see it as a chart. So what happens is, if you get hit with an X, and X could be positive or negative, somebody comes to buy from you or sell to you. What you go in to do is, you go in to set the ETF price to compensate for the costs that you bear. That's all that you're going to do. So think of it as a two-sided bid-ask spread. Only in this case, there will be two parts to it. One is a bid-ask spread that you're setting up to protect yourself against the liquidity shock. Yeah? So you're going to charge someone because you have a cost to compensate for. You know it's going to be costly to you. And the second one is the net asset value. The net asset value is going to move because when you go into the secondary market to manage, when you go into the underlying market to manage your inventory, you're going to move it, again, as a function of it. So two things are moving, all of them as a function of X. And this is how our mispricing, or the difference between price and NAV, arises. It arises naturally out of the static model as a result of costs, that inventory costs and price impact costs that the authorized participant is exposed to. They're going to set these prices and they're going to make impact in the market. And so because of their central role here, it's going to come up. It's a feature, not a bug. Yeah? So, yeah.
And the inventory of underlying security?
Inventory of the underlying security, we are not looking at. We're only looking at the authorized participant in the ETF market, and they do something in the underlying. But that's something we're fully parameterizing by their price impact cost, and that's it. We're not looking at, they may of course be doing other things in there. Yeah. So very simple model. What you can think of is what this gamma is, what this gamma star is. You can think of it as a slope of the line, of the inventory line in the primary versus secondary market. So if I put the primary position of now different authorized participants on the y-axis and the secondary position on the y-axis, then if they're exactly on the 45-degree line, then they're buying from one, selling the other, or selling the one, buying the other. You can see that they deviate, and you also see that these different dots represent different types of authorized participants in that same ETF that I showed you before. So we need some dynamics. So we've put together a dynamic model. A dynamic model, everything is going to be moving. There will be many periods, not just one period. There will be informed and uninformed demand. So our authorized participant will have to figure out whether demand is coming partly from informed source or uninformed liquidity trader. There will be dynamic optimization. There will also be the underlying ETF, underlying value of this basket V that's going to be sort of moving around. There would be a lot of moving parts. They're going to be fundamentally solving for the same thing. They'll be solving for how much inventory to keep. Yeah? So they'll be solving at the end of the day is how much inventory to keep and how to set the price in order to manage this inventory, given that information is moving, different types of participants, it's a multi-period optimization problem. It's still going to be that gamma that they're going to solve for because we observe what that is. We observe what they do. Yeah, so we can link it to now the data, and the question that we're going to ask, is our hypothesis correct? Is their inventory management in some way related to mispricing? And if we go and we decide that whatever it is that they do in the managing their inventory has absolutely nothing to do with mispricing, then this is all kind of a moot point. Yeah. So this is to organize ourselves. And the way that we're going to organize ourselves, I'll just go through this. I'm going to just get you to the mispricing equation. So the mispricing equation is going now be, it's going to be x prime and x. So it's going to have memory now. It's going to have memory. It's going to have an autoregressive component, and it's going to have jumps relative to information. So we are looking at a data generating process that potentially could help us get to this. So data. We have primary market data from two large ETF issuers, MiFID II transaction level data. We have daily data 2012 through 2022 over this. We have 128 ETFs. 50 are equity ETFs, 78 are fixed income ETFs. We know for every transaction, we know when, how, who, which market, and who they are. Yeah, so we know what APs do. We can calculate their inventory. We can see how they manage it, and all of that. We also have some public data that we need to look at, which is we have controls as the usual thing. So their inventory management, so the chart that I showed you before, this is flow traders, the high frequency trader, looks more like a fan chart. But we also see kind of things like this and kind of things like that. This is a bank. So we can see that this is Optiver. Optiver is buying in the secondary market and buying in the primary market and just accumulating positive inventory. Well, we don't know why. So they're doing something. Yeah, so we can see that the patterns differ. So presumably their inventory management differs depending on just sort of what they do. And we want to see how does it impact the price, because they all go into this market. So we will set up a structural model, and our structural model is going to, let's see where that structural model is. Yeah, I need to end, right?
Yeah, it's 15 minutes past.
Yeah.
I'll give you 15 minutes of my time.
Okay.
Good trade.
Sounds like a good trade?
Yeah.
So we have the structural model. So in our structural model, what we have is that this is going to be an inference exercise. So we're not going to be testing hypothesis. There is no null hypothesis here. What we're going to do is we have a model, and this model tells us how different parameter values should interact with each other. So we're going to be inferring parameter values from the data, given the data that we have, given the IDs of APs. Yeah? This is what the structural model buys us. As you can see, it has memory, it has some sort of structure on how their inventory should be moving around, and some price variables in there. So prices of the underlying and price of the ETF. So what do we find? What we find is, I'll skip you through all of that, through all of these slides. It's basically telling us how we set things up and where do we go about it. We're going to cluster our market participants into 3 different types: banks, high-frequency traders, and others. We're going to focus on high-frequency traders as they, to us, look like the most important for the price discovery of this thing. As you can see, group 1, group 2, group 3. And then we're going to run our mispricing dynamics inference exercise. And on this inference exercise, we want to see whether or not this variable, mispricing, that is observed, is related to inventory management dynamics of group of participants in this market. And if the answer is yes, it's highly related, then we're kind of on the right track. We say that the inventory management activity is highly related through the structural model to the mispricing that we observe, that they accumulate some inventory, they hold on to this inventory, they gradually deal with this inventory, and that translates into mispricing dynamics having the empirical properties that we see it having. That is where we're at. So I'd love to hear from you is in the 30 seconds, if possible, what would you like to see? Because there is, as I said, we've inferred from the data, based on the structural model, that there is something there. We have amazing data. We have a model that finally is a model of ETF pricing. We didn't have a model of pricing ETFs before. Now we do have a model of pricing ETFs. This model we've tasted on very good, very clean data, and it seems like this model holds. If I don't have time now, talk to me and tell me, what do you want to see?
Coffee break, 3:30, meet at
3:30. At 3:30, I'm going to be there during the coffee break. So talk to me and say, Andrei, this is interesting. Tell me more about this.
Yeah, I'll be there.
You'll be there?
Yes.
Albert, you have questions that you want to ask me? Not now. It's by 3:30. Anyone else? Zvi, you have ideas. Natalie, you have ideas? Not philosophical, like, structural model and things. So anyone else of you who says, Andrei, this is what we want you to do with this. You've gotten us this far. This paper does not have an ending.
We understand.
As you can tell. We need to wrap it up. Thank you very much for your time.